Imagine owning $10 billion in stocks and almost never selling them. Sounds ridiculous, right? Because if you had that kind of money, you would probably cash out immediately, buy a mansion, travel the world, maybe retire forever. But here's the strange part. Most billionaires rarely sell their stocks. In fact, many of them go years, sometimes decades, without selling anything at all, which raises a very strange question. If their wealth is locked in stocks, how do they actually spend money? And the answer reveals a financial strategy so powerful that it has a nickname on Wall Street. But before we get to that, we first need to understand how most people think money works. For most people, the system is simple. You work for income. You save some of that income, then maybe you invest it into stocks. And when you need money, you sell those investments. Simple. Sell stocks, get cash. That's the normal process. But there's a hidden problem with this system. Every time you sell stocks, you trigger something called capital gains tax, which means the government takes a percentage of your profits. And depending on the country, that tax can sometimes reach 30 to 40%. Now imagine this situation. A billionaire founder owns $10 billion worth of company stock. If he sells just $1 billion, he could instantly owe hundreds of millions in taxes, which means selling stock is extremely expensive. But here's where things start getting interesting. Because billionaires discovered a way to use their wealth without selling anything. And the trick begins with something very ordinary: a bank loan. Now, normally, people take loans when they don't have money. But billionaires take loans because they have too much of it. Which sounds backwards, but banks absolutely love lending to billionaires. Why? Because billionaires already own massive assets: stocks, companies, real estate. And those assets can be used as collateral. Collateral simply means something valuable that guarantees the loan. So imagine this situation. A billionaire owns $20 billion worth of stock. He walks into a bank and asks for a $200 million loan. For the bank, this is the safest deal in the world, because if the billionaire somehow failed to repay, the bank could simply take a small portion of his stock. So the bank happily approves the loan. And suddenly, the billionaire has $200 million in cash. But here's the detail that makes this strategy so powerful. And it's something most people completely overlook. Loans are not considered income, which means they are not taxed. And that tiny rule changes everything. Once the billionaire receives the loan, he can use the money however he wants. Buy houses, invest in new companies, purchase art, travel, or fund entire businesses. From the outside, it looks like he is spending enormous amounts of money, but technically, he never earned any income. He simply borrowed money, which means he avoided the taxes that would normally happen if he sold stocks. But there's still an obvious question. Loans eventually have to be paid back. So how do billionaires repay these huge loans? Do they suddenly sell their stocks later? Not exactly. Because what happens next is where the system becomes even more fascinating. Instead of paying the loan back, they often take another loan. Imagine the timeline. Year 1, a billionaire borrows $100 million using his stock as collateral. Year 3, his company grows rapidly. The stock price doubles. Now his shares are worth twice as much as before. From the bank's perspective, this makes the billionaire even safer to lend money to. So the bank offers a new loan, maybe $200 million this time. Part of that loan pays off the old loan, and the remaining money becomes fresh cash. So the billionaire now has new spending money without selling any stock. And this process can repeat again and again and again. As long as the assets continue growing in value, the loans can continue being refinanced, which creates a fascinating financial cycle. Borrow, refinance, borrow again, repeat. This strategy allows billionaires to access enormous amounts of cash while keeping their assets untouched. But the most surprising part of this strategy still hasn't appeared yet, because the final piece of the puzzle happens after the billionaire dies. And this is where the biggest tax advantage appears. When someone dies, their assets pass to their heirs. But in many tax systems, something unusual happens. The value of those assets resets. This is called the step-up in basis. Here's why that matters. Imagine a founder who bought company shares decades ago for $1 each. Over time, those shares grew to $500 each. If he sold those shares during his lifetime, he would owe taxes on the $499 of profit per share. But when those shares pass to his heirs after death, the cost basis resets to the current market price, which means those decades of gains essentially disappear for tax purposes. The heirs can sell the stock with little or sometimes no capital gains tax, which means the billionaire managed to enjoy his wealth for decades without triggering the taxes that would normally happen when assets are sold. And that entire system has become famous among wealth advisors because it follows a simple three-step pattern. This strategy is often summarized with 3 words: buy, borrow, die. First, buy assets that grow in value. Stocks, companies, real estate. Second, borrow against those assets instead of selling them. This allows you to access cash without triggering taxes. And finally, when the assets pass to the next generation, the tax basis resets, which removes the large capital gains taxes. Now, it's important to understand something. This strategy isn't illegal. In fact, it operates entirely within existing financial rules, and it's widely used by wealthy investors, founders, and real estate developers. But it also reveals something important about how wealth works, because at the highest levels of finance, people don't treat assets the same way normal investors do. Instead of seeing stocks as something to sell, they see them as collateral for borrowing power, which transforms assets into something even more powerful than cash. Of course, there's a reason most people don't use this strategy. Banks are only comfortable lending huge amounts of money when the borrower owns extremely valuable assets. If someone owns $5,000 in stocks, a bank probably won't offer a multi-million-dollar loan. But if someone owns $20 billion in assets, banks compete to lend them money, which means this strategy mostly exists in the world of the ultra-wealthy, where assets grow faster, loans are cheaper, and financial flexibility becomes enormous. And that's why many of the richest people in the world almost never sell their shares, because in the world of billionaires, borrowing against wealth is often far more powerful than selling it.